So, hi everyone. I'm here with James Fell today, who's the CEO of Credit Canary, and Credit Canary are sort of in the customer engagement space, particularly around some of the really understanding what credit worthiness is and affordability is. Really trying to engage customers as much as they possibly can. So James, thanks very much for joining me today. I really sort of appreciate it.
No, thanks for having me.
So I suppose given the space you're in terms of like I suppose augmenting, additional data, looking at I suppose people's credit worthiness. I mean, what are some of the trends that you're kind of seeing in the market, particularly as we sort of start into this new year as well?
Yeah, so with regards to kind of credit decisioning and kind of the role of data within the lending life cycle, very much what I've seen is that there is very much a dominance of the use of it within kind of the loan origination and decision making.
Mm,
Elements of it used within collections and recovery, but very little is done to kind of provide early warning of
mm,
financial distress to those borrowers that are facing financial hardship. And coming
mm,
into the start of last year, we saw the cost of living crisis driven by rising interest rates, the war in Ukraine, rising inflation, and very much saw it as an opportunity to help those borrowers before the point of missing payments to
mm,
keep them on track. So very much like the key trends that we're starting to see in the market are like, firstly, whilst lenders aren't starting to see um, default rates start to increase rapidly in response to cost of living crisis, very much driven by a lot of borrowers having saved during the pandemic period,
mm,
creating a bit of a synthetic outcome. Very much there is a typical concern about kind of when these changes are going to start rolling through
mm,
into kind of how the behavior of borrowers takes place. The second one that we're starting to see is there's much more of an openness to want to engage customers and use recurring data. There's very much been a tendency historically to not want to have that access to recurring data, very much with a concern about what they may or may not find, or secondly, that they're not sure about like what to do with those customers that are in hardship. But actually, in response to kind of these macro trends that we're seeing, there's much more of a propensity for those lenders to want to have that recurring data feed as a way to provide better kind of customer
mm.
experiences and really align to new consumer duty.
I mean, do you think there's more innovation, I suppose, out there, and I suppose readiness to accept innovation? I mean, back in the old days, we used to very much be reliant on, I suppose, credit bureau information, those kind of things. I know there's a whole new suite of information that's sort of out there, and you sort of augment it with different pieces. Do you think there's much more readiness and acceptance to be able to do that? I mean, has that changed over the last 5 years? Is that still changing now? Do you think?
I think kind of as a result of these macro changes, that there's very much been a tendency
Mm,
to change and like want to kind of make kind of make look to address, and that's been driven by those macro trends and the regulatory trends. Um,
mm,
if you were to kind of like look to start the business that we're creating, say 3 or 4 years ago, it might not have had the kind of impetus and the real market
mm,
need. Whereas like now, there's a very much kind of a demand to want to be able to kind of serve those customers and ensure that kind of we're engaging them before the point of default because it becomes like very costly at that point and the options are quite limited. So yeah, very much there has been a tendency within the market to want to kind of move to make the most of these new data feeds that are available. But whereas kind of in trying to do that, what we've seen is a reliance on credit data. And the
mm,
challenge with credit data is that whilst it gives a very much a detailed insight into a borrower's financial health, because of the nature of it, that it typically is not real time and kind of
mm,
updates to bureau files can take between 30 to 75 days to filter through. Having a
mm.
very reactive kind of way of dealing with that has not been possible. And that's why Credit Canary is looking to address that by merging aspects of the transactional data with credit data to put those
Mm.
lenders in a real time position to be able to drive change.
Yeah. So this is all this idea around almost like recency of data. It's just like how do you sort of get ahead of it in terms of like almost like the time frame's getting shorter, isn't it? In terms of like changes are happening quicker, and we need to get updates on a quicker basis as a result of that.
Yeah, very much. It's trying to catch those people at this moment that they'll have, which is
Mm,
like I'm going to miss my next payment, and very much you know borrowers have that feeling. In the past, I've been in that position myself, and yeah, it's trying to catch those people and use the data, to for good to kind of identify those scenarios, catching
Yeah.
them ahead of time with proactive solutions to avoid them missing that payment, which then leads to a knock-on effect, which affects their future propensity to lend or borrow.
Yeah. I mean, so like this almost like pre-collections, as we'd say in the collections world, almost like this pre-arrears type conversation, almost like how do we look for these like small indicators that might be indicative of something happening in the future? I mean, how far out do you think we can kind of look, and how indicative how indicative are some of these measures? And I suppose because it's becoming increasingly important, especially with cost of living, as you say. I mean, like people aren't yet necessarily in arrears, but they might be in the future.
So yeah, so for Credit Canary right now, like what we're focusing on is accuracy. So right
Mm,
now we're focusing on the next 30 days, forecasting
mm,
forward and trying to achieve a high level of accuracy on that front. And
mm,
the way in which we're going about forecasting on that is aligning to three pillars. So one is what is the borrower's ability to pay? So,
mm,
do they have the disposable income available? And looking into kind of categories within the transactions to look at what's happened previously, but actually add a level of realism going forward. So, for example,
mm,
energy bills, what you've been paying in the last 12 months will not be indicative of what you're going to pay going forward. So, adding elements into that, starting to look into the second pillar, which is financial behavior. So, what are the trends that we're spotting
mm,
within there? And then third is around those financial, the willingness to engage. So, because we're looking to serve the treatments, we're seeing which of the borrowers are engaging versus which aren't. We've
mm,
got a kind of a good steer about what that looks like. Where I see that kind of ultimately like spanning out is through understanding with more data. We look into the focus is to then extend that 30-day accuracy point to say 90 days and then pull it
mm,
out, say 120, and then make it kind of very much like for looking so that we've got a real kind of indication as to what future affordability looks like for a borrower, and then use that as a
mm,
proxy to understand the likelihood that they will go on to miss payments. And then where
mm.
relevant, engaging them proactively to avoid them going into default.
And what about the customer aspect of it? And I know you sort of provide this to companies, but there's a customer aspect to it. One, in terms of like, I suppose there's been resistance around, looking at some of this information because customer feels like it's a bit like an invasion of privacy. I mean, is that moderating a little bit? And then the second question is then, well, what do you then say to people? Because they're not necessarily in arrears yet, but you think that they might be, particularly if you look at your 6 month scenario. It's kind of like it's really quite a long way out, and it's almost like this future look, and sort of people feel that it's almost like, I mean, people still feel like, well, that's a bit of an invasion of my privacy. You're making really big assumptions there, and that's not me, if you sort of know, even though it might be predictive.
Yeah, so I think it all starts with a value exchange that exists with
Mm,
between the borrower and the lender, and it's making sure that that value exchange is right. And that really is
mm,
like where we're spending a lot of time working. So, what can we be providing to the borrower,
mm,
which is valuable, and that can like give them the necessary motivation to have them willing to share their information, uh,
mm,
and vice versa. So I think the most important bit with this all comes to this value, the idea of the value exchange, which is a central
mm,
ethos of the business and where all of our testing right now is going into. And very much then it kind of comes on to then what do you say? So knowing that we've got this kind of idea of the value exchange is first and foremost really important. Then what do you say is then how does that value exchange transpose to treatments? And what Credit Canary's done is we've defined 14 initial core treatments that can range
mm,
from making an early repayment to a forbearance kind of measure, um, to kind of give that borrower the various option depending on the nature of their financial circumstance. We haven't, we are early in our kind of development journey. To be open on that. But having that kind of underlying appreciation for the value exchange is really key to change the
mm,
dynamic of making it about this is an invasion of my privacy to becoming much more about this lender is looking out for me and is wanting to
mm,
kind of help me during this kind of time of need. And
mm,
therefore, when it comes later down the line, when they're starting to think about relending or their financial position has become a lot more preferable, they're much likely to have strong advocacy with that lender. So it's all about the value exchange, and that's where we're spending all of our time to get right, and
Mm,
changing it from I need this loan immediately and I'm willing to share my
mm.
data at that point of time to do that, to actually providing more enriched, fulfilling digital experiences that borrowers are willing to share their data
Mm.
within the life of the loan.
Yeah, there's quite a big trust angle to that in terms of like it's like how do you trust the brand you're dealing with, providing information and they're trusting you giving the information back, and that's almost like an underlying theme to a certain extent. It's like how do you trust each other to provide look out for them, and I know it links to things like consumer duty as well, which is
Mm.
coming through is very much in line with that as well. But do you think like that trust maybe we've sort of gone through a period of maybe us not trusting each other as in consumers and businesses, and this is a way of us almost like starting to do that when you talk about value exchange.
Yeah, I'd see, I think it's in considering trust and where trust is going. I think it all starts
Mm,
with like communication and changing the nature of the relationship that's existed
mm,
historically between lender and borrower.
mm,
And very much like where we're starting is like is using different forms of communication between those to maybe soften the
mm,
nature of how that relationship exists, and making sure that there's more transparency between both sides. Ultimately, like it's in the best interest of both sides if both sides stay ahead of
mm,
you know their scheduled payment plans, and very much that's the core ethos of what we're doing. So yes, trust is key, but the nature of kind of how lending has existed historically, not just within the last 10 years, but the last 5,000 years, for example, as long as far as debt goes back, there has been this imbalance, and very much we see it as an opportunity to address that, and that's one of the key kind of underpinning pillars that supports the vision of the business.
yeah. Outside of the credit bureau information, what do you think are some of the key things to really look at, or the innovative kind of data sources that you think, well, like, we spent a bit of time looking at this and we think this is fairly predictive and it could be kind of useful, but it's really at high level.
Yeah, sure. So, like what Credit Canary does is it combines the product information, so the loan and the non-identifiable
Mm,
information about that, the open banking data or transactional data, depending on whether it's a
mm,
bank or not, and then the credit file. And effectively, what we're doing is we're reconciling the three. So, where the credit file picks up information about the borrower's financial health, which
mm,
isn't kind of on the transaction file, and vice versa, it creates a full picture. And then what we're doing off the back of that is we're taking that as the baseline to forward forecast a borrower's net disposable income. So
mm,
looking to identify what we believe is going to be in a borrower's bank account or their net worth at the end of every individual day. And then when that drops below a specific threshold, we then use that as the basis to then serve these treatments. But very much the net disposable income is the key to it, as the
mm,
core layer, and that very much is the atomic metric of the business. And then on
mm.
top of that, it's about kind of adding additional trends and behavioral traits that could indicate a potential for change in behavior or financial circumstance.
Yeah. I mean, certainly as we sit here at the start of 23, when you look at cost of living started to come through, as you said, it's you're not necessarily seeing that in terms of arrears levels yet, but cost is definitely there whenever you go shopping, right? So energy costs have been going up. We've also got interest rate costs are coming up. There's talk of even more I suppose inflation coming through in the back end of the year. I mean, what's your sort of outlook for 23? I mean, what are you kind of seeing? I mean, how much pain do you think we've got kind of ahead of us, do you think?
I it I it's funny at the moment. It's a strange time, and it doesn't matter who
Mm,
you speak to. Everybody has been affected for cost of
mm,
living crisis. The like whether it's interest rates or the cost of food or the cost of goods, like everything is being affected, and it just has a direct effect on things. I think that with regards to like where we are now, what the next 12 months like, it's very much an unknown. But what I do foresee is that like the challenges around cost of living will remain.
mm,
What I hope is that a lot of the challenges that we see in the market around rising interest rates, as a good example, with kind of 68% of households in the UK having mortgages, for example, um, whether it's kind of like a mortgage tax or those that are on flexible rates, you know, it's quite a strange time, and the kind of standard kind of economic levers that government and will be pulling aren't necessarily like feeding through. So um, it's quite an unknown. It's a bit of a finger in the air, but like what I do believe is like these challenges around disposable income are only going to get worse within the next
Yeah.
1 to 2 years. And where I see fintech as the kind of key driver is being able to provide that innovation to allow for households to navigate it in the best possible way.
It does feel like sort of getting ahead of it and doing the pre-collections, the pre-arrears piece is kind of getting those indicators in now seems like a good way, and at least trying to like build relationships with customers now rather than waiting for something to go wrong, maybe in 3 months' time or 4 months' time or 5 months' time. I mean, because then it's very difficult, isn't it?
Yeah, very much. But if you can take parallels to like different in like say for example like health, like
Mm,
people want to know about kind of like the nature of their health. If you look at the types of products that are starting to come out into the market by the likes of Randox, where people are taking doing blood tests and they're wanting to be a
mm,
lot more proactive with regards to the nature of their health. There's one good example. Um, and there are others, that exist in market as well. But very much like we kind of see there's an opportunity to use this data as the black box for your car to make
mm,
sure that you are being rewarded ultimately, um, and that the financial products that you have when life does change um, has an element of flexibility to it to
mm,
ensure that you have that space to get back on track without your kind of wider financial existence
mm,
being
mm.
threatened.
I mean, the transactional detail is kind of interesting in terms of, I mean, because it's a mine of information. I know we've been talking about it for a while, and it's taken a while to sort of get almost like get critical mass. But there's almost like there's the basic kind of information, but there's also things like the order in which transactions come in, the different kind of, I mean, there's all this like an extra wealth of information that's out there, other than just sort of almost like adding it up. I mean, do you think we're going to get to that in terms of like looking for these micro indicators, these small indicators, are like this is indicative, and you must start to see some of that in your kind of work.
Yeah, so I've worked within open banking since 2019, so like very much like
Mm,
familiar with a lot of the nuances that exist across the board in how that data comes in. And
mm,
there's definitely still a way to go within categorization and how that works,
mm,
um, and how it's kind of standardized across the board. But I think that the kind of inconsistencies right now do create a lot of opportunity still. That there's a lot of
mm,
opportunity to be doing more. And it's a shame that the categorization as a good example like exists the way it does, because if fintechs and technology companies didn't have to deal with the burden of standardizing the categorization and spending extensive resource in doing that, they could actually go to then use that data for much more beneficial outcomes. But we are just scratching the surface with this open banking data, and I think there's a mindset shift with consumers, and we're starting to see we see steady adoption, but it's
mm,
not prolific within the market, and that will go to change as that value exchange becomes a lot more apparent, where customers are a
mm.
lot clear about what they're getting in return for sharing that information. And then innovation with regards to like how it's used and more innovative use cases for it. So yeah, data wise, it is a challenge, but what we're doing is we're sitting on top of it to ensure that we can use that information to start to forecast forward. And actually,
Mm.
as that data becomes more sophisticated, the accuracy of our prediction becomes in turn much better.
I mean, I suppose even just in terms of like the wealth of the data, there's a wealth of data there, but then you still need the almost like the human to then look over it and come up with the different scenarios to say, well, look, let's test this and see if it's predictive. I mean, so you've got to come up with all these different scenarios, but it's almost like endless in terms of what you could actually look at. And I suppose it's just going to take time while we churn through it and really understand, what works, what does not work, what's predictive, what's not, those kind of things.
Yeah, very much so. And that, that you have like other scenarios which make it even more challenging, whereby if you're dealing with like different subsets of a
Mm,
population that are kind of indicative traits that exist within prime, similar to what
mm,
exists in subprime, clearly not.
mm,
But very much like trying to be kind of a first mover in the space to get ahead of that and really kind of
mm,
spend the time to get under the skin of these nuances that exist. It sets us up quite strong to really kind of push forward because we've got a clear point of difference as we very much on pulse of exactly what's going on, not just as a whole, but within these like nuanced sectors or subsets that sit within the population.
What about integration? I mean, we see a lot of sort of, there's a lot of sort of fintech startups that are taking place, and they sort of like specialize in one particular area, and they do that really, really well. And you can almost like see it starting to we're getting to this world of, it's like we have got lots of different multiple products that are getting embedded into a much wider process for a creditor, as an example, or for a business. I mean, where do you sort of see that trend kind of going on? I mean, obviously, it's like how easy is it to integrate? How is it to basically now talk with all the other products out there? I mean, is there that really getting to a point of a sea change where we're going to see a much wider suite of companies out there sort of being embedded? It kind of feels like it.
Yeah, I think there's very much like been a movement like within the financial services sector, which
Mm,
has been driven by these cloud native banking
mm,
platforms that look to operate by becoming more of the orchestration layer and then building in and around it best in class solutions that serve that. What Credit Canary is doing right now is looking to kind of offer a base API, which is serves
mm,
for those initial kind of clients that we are looking to engage with. But actually, our long term growth, we believe, will come through innovative distribution partners such as
mm,
banking as a service. So if you look at the likes of like Thought Machine has a product library, Mambu has a marketplace, you're starting
mm.
to see like new types of company come out to make that integration a lot more easier, such as Sequoia. So very much like that, I think the key change that we will see is as the adoption, especially within larger enterprises, of these like more cloud native solutions coming into play and then becoming a lot more widespread, the
Mm,
accessibility of those more innovative solutions like Credit Canary will become far easier because you're
yeah,
effectively taking it through your core provider and effectively the due diligence and all of the relevant kind of checks have been done up front, and it means that as a whole, the banks can then get use that as a basis to get a lot closer to their customers, and become a lot innovative from off
mm,
the outset. And we're already seeing that trend pushing forward,
yeah.
and it's set to be a lot more prolific within the next 2 years.
Yeah, I mean, you see that, for example, in the gaming space, where you sort of like you have marketplaces, or even in terms of like Microsoft Store or Apple Store, where you can almost like you go in, you can sort of press a button, and then it basically installs, and all that integration is basically done. I mean, so you think that could potentially come into, for example, into the collections world with collection systems, or it might be with banking as a service type systems, where it becomes like a marketplace, and sort of you just be able to install it, and then it becomes an ongoing fee to a certain extent.
Yeah, very. I do see that become a lot more. The interconnectivity between kind of various
Mm,
solutions that are used within the collection space will start to like come through a lot more. I think what we're starting to see within the lending space and the lending management side, a lot of innovative solutions starting to come through with kind of new challengers looking to kind of uh, challenge on the lending management side. There's a firm called
mm,
Noble coming out of the US, which are making it a lot more innovative and accessible. Lenders are wanting to adopt kind of cloud native solutions because they're easier to manage
mm,
and maintain, and for the most part can be cheaper than legacy systems. So that will naturally like trickle down. And what I believe we're already seeing is that these core banking providers or lending management, whatever we want to call it, by kind of having more of a kind of networked way of operating, it allows them to
mm,
effectively serve those clients right the way across the lending life cycle, right the way from originations to default, or collections and recovery, and even debt sale, in a much more simplified and easier way to deliver
mm.
to the end client.
One of the big changes we talked about cost of living, and I suppose in interest rates increasing, but one of the big changes that also has is in terms of like funding and return on funding, return on investment, those kind of things. Do you think that's going to have an impact in terms of, certainly if you're looking at like the fintech world, where you've got private investors basically looking for a certain return because they're looking for higher returns than they've seen elsewhere. I mean, do you think that's going to have an impact in terms of this sector, in terms of like investment funds being available, or maybe in terms of like demands on the fintech sector in terms of what they're expecting in terms of getting a return?
Yeah, well, so you could break that out into two different kind of like scenarios. So, firstly, you can look at it from like an equity side, and from an equity
Mm,
side, there has been very much a change within the appetite.
Mm.
The amount of due diligence is like widely noted within the founder community of where a lot of like institutional funds have done, say a couple of years ago, to what they're currently doing now. It's a lot more
Mm.
diligent. They're looking to ensure that things are kind of there's a conservativeness that exists within that space,
Wasn't before, yeah.
um, which from our perspective, with a company which is grounded in integrity, we see as a positive because we want to kind of really thrive in that space. And then from a debt perspective, if you're kind of acquiring wholesale debt, it ultimately is going to get more expensive, which is either going to kind of reduce margins or kind of be passed on to the end customer. So it
Mm.
from those perspectives, definitely there are changes coming through. Um, it's just an inevitable of kind of these macro shifts
Yeah.
that are happening. But where we're kind of concerned about it as a business is actually looking at it from the customer perspective and actually
Yeah.
how the nature of these impacts are impacting families.
Yeah.
And it doesn't matter, whether like what kind of section of society you're from, like everybody is feeling the pressure on this,
Mm.
and it's why we're starting to see terms such as the squeeze middle like come through, because large kind of aspects of society which previously had been very prosperous, are now starting to feel the pressure. And we're also seeing a lot of kind of like families coming out of like 3, 4, 5 fixed term deals on mortgages and struggling to get fixed term mortgages, or
Mm.
just with kind of like the nature of kind of or preference of banks, fixed
Mm.
term deals are very very hard to get. So we're seeing this shift towards kind of more variable rates. But yeah, that's kind of like where we're thinking of it at the moment.
Yeah. I mean, do you think we've got enough support in place today, or do you think there's have to be new support mechanisms that need to be out there from a customer point of view? I'm thinking, just for example, your example there was around someone's on a fixed term mortgage, they then need to roll it over, but they can't afford then the rollover, which causes, which causes problems in itself. I mean, is there enough support out there? And is enough support out there, I suppose, in terms of like other sectors, and I'm thinking about the charitable sector as well, where people are starting to newly get into debt, they're newly starting to find maybe other kind of issues as well. I mean, do you think we're robust enough? Do you think we've got enough capacity within those sectors to be able to handle what might be coming down the road at us?
I think you can always do more. Like
Mm.
wherever it is, there's always an opportunity
Mm.
to kind of like make change and disrupt. Across the board, it's a very like vast question. I think kind of there's a couple of things that I've definitely seen that we could do a lot more effectively. So like
Mm.
obviously we're trying to help those customers in life, but I think kind of one of the big things that can be done right now is to actually help customers at the point of credit decline. So in
Mm.
the UK there are a high number of people that are declined for credit every year. What
Mm.
in doing so they receive very little information about what are the next logical steps, about what they can do and like what help is
Mm.
available to them. So I think that there's a real kind of opportunity to use these kind of compelling events to help people at their point of need,
Mm.
and to make sure that people are in sustainable solutions going forward. So it's a lot better to
Yeah.
keep, like, of my opinion, it's a lot better to keep people within a sustainable pattern than put them in undue pressure and undue stress, which is ultimately then going to lead to like further downcline.
Yeah. I mean, it certainly sounds like getting ahead of the curve, having honest conversations, being transparent to what honest and integrity in terms of the business model. I mean, they all seem like great themes for this year, and trying to head off problems before they actually become bigger as well. So I mean, it's fascinating topic. It sounds like we're going to have probably hear a lot more about it for the rest of the year. So James, thanks very much. I appreciate the insights.
No, thanks so much for having me. And yeah, very much like it's a great opportunity. It's a great time for Credit Canary to take what is an unfortunate position for both,
Yeah.
families like across the UK and the country as a whole. To help those families navigate this time, and to make sure that they feel that they've got kind of uh, yeah, solutions in place to help them, push on and kind of get back to more of a prosperous
Mm.
place.
Yeah. Yeah. Absolutely. So, well, thanks very much, and we'll chat again soon.
Cool. Thanks very much.